Hi, I'm David Abel from Vision Dental Wealth, and I'm joined with Simon, Head of Tax at Hive Business. And I just wanted to talk about something a lot of my clients are going through at the moment and a potential opportunity for some planning. And that's when they're limiting themselves at £100,000 worth of income so they don't fall into the 60% tax trap. But they need to pay for school fees and they need to pay for big capital expenditure and what the options are. So Simon, do you just want to explore what you've done for some of your clients and how you've helped them through that issue?
Yeah, definitely. So, I mean, it's even worse at the kind of 100K level, but what we see is, a lot of people operating through a limited company, generating all their profits in a limited company. But of course, a lot of expenditure is not going to be business. Life is not business expenses. So that money has to come out of the company. For a higher rate taxpayer, we say that for every kind of 10 grand you need, there's 5 grand of tax. It's even worse in that period where you're losing your personal allowance at 100K. It's just going to be really painful to lose those allowances. So, that means if you need to spend 10K on school fees for a term, you actually need a 15K dividend out of your company. That's really painful. That pushes you up through those limits really, really quickly. There are alternatives. It's not, again, with most of these things, it's not a one-size-fits-all kind of solution. But one thing we've looked at with people is maybe let's just find a way to not need to call that a dividend.
Yeah.
There's lots of people out there talking about school fees planning. They have done for years. The tried and tested way of dealing with this is often to involve the grandparents, I suppose. Give the kids' grandparents, i.e. your parents, some shares in the business, get those into a trust, let that receive dividends to pay the school fees. I think there's only a narrow set of circumstances where that works. There is a narrow set of circumstances where that works.
Yeah.
But in most cases, that's just not going to be possible. It's so artificial in the way it's put in place, and it's designed to sidestep a rule that says you can't just kind of give your kids some dividends.
Yeah.
So they say, well, actually, if we go up to parents and then down to grandkids, you've never given your kids dividends, but you've achieved the same thing. So those rules do actually still apply. And HMRC put out what they call a spotlight on this a couple of years ago now, after a firm that was auditing the S&P got in trouble for a bad audit.
Yeah.
They were also doing this. And then a spotlight got put out, which is HMRC saying, look, we know this goes on. We don't like it. Like, you just can't do it.
Yeah.
Lots of people still are. So when we talk about school fees, that's what a lot of people think we're talking about. But we're not. Actually, what we're really talking about is just being kind of absolutely ruthless on how you optimize what comes out of your company. Don't take more than you need as a dividend.
Yeah.
There's other ways to get money out of your company.
And those ways, I mean, we'll come back to, because that using the grandparents, if that is a genuine route, that is a really tax efficient option to do it. And you can save, I mean, we've done a calculation where we've got a mutual client and it will save them over £600,000 in tax over a 12-year, for 2 kids, 12 years of private school fees. So it can be great, but it's only a certain set of circumstances that can apply, like you mentioned. And I think some people have received some bad advice on that. And it's just basically understanding if you're in that position, it might help just to have a sense check on if that's up to scratch.
Definitely. It's been productized quite a lot and sold as an off-the-shelf solution. Hey, we're going to create some shares, give them to your parents, put them in a trust, pay some dividends, give them to your kids. Like, it sounds nice and neat when you say it, and if you don't understand why it doesn't work, it sounds like it should work. Actually, it was probably a great idea once upon a time, but it just doesn't work anymore. But like I say, it can. So if there's a genuine reason why the grandparents have shares in the business, or if the grandparents are starting with the capital perhaps, and they're actually going to give some cash to the kids who might then buy the shares, for example, there are a set of circumstances where that can work, and it will be really tax efficient. It's just where it's kind of put in place artificially that it really, all you're doing is setting up an arrangement that is the same as you giving your kids a dividend.
Which could end up with some nasty surprises.
Well, it just means that those dividends will be taxed on the parents. Yeah. So you may as well have just given yourself a big dividend in the first place.
Yeah.
And it would have happened by the time you find out that this was not okay. You would have done it irrevocably. So that tax is going to be due.
And then if we were to go back, okay, that's a unique set of, or a small set of circumstances where that can apply, which we've discussed. When that isn't an option, what are the other options?
Well, like I say, I think it's about being just really ruthless with what's coming out of the company. So one thing that becomes quite common is, like, yes, you can have a dividend, and yes, you pay some tax on a dividend. You might be perfectly fine with that. There are, again, some circumstances where you say, well, actually, I'm not going to have a dividend. I might just borrow this money from my company. Companies are able to lend money to their directors or shareholders or staff members or whatever that is allowed. It does cause a tax bill. So a lot of accountants approach this with, well, hang on, there's a tax bill anyway, so why bother? But it's fundamentally different because it's a company tax bill, not a personal tax bill. So the way the calculations work, it's a smaller tax bill.
Yeah.
And secondly, it's a tax bill on a loan. If that loan ever gets repaid, and I would stress, I think you need to have a plan to repay the loan, that tax gets repaid.
Yeah.
The whole kind of purpose behind that tax is they're saying, okay, well, you're in control of this company. You've been able to choose to borrow this money instead of having a dividend. We'd much rather you have a dividend from the perspective of HMRC because we get our tax on that. So we're going to create a company tax to tax the loan as if it were a dividend.
Yeah.
But if you do ever repay it, then we accept it. Okay, it genuinely was a loan because you've repaid it, so you may have your tax back. In the right circumstances, where there is a plan to repay it, that can work really well.
We've done this with some clients where we've set up pension contributions from the company to offset the tax which has been generated by the loan.
Yes.
And that works for two reasons. One is it offsets the corporation tax or the tax due.
Yep.
And the other is it builds up a pot. So when you do come to draw down from your pension, you could use your tax-free cash to repay the loan as an option.
Yeah.
But you could also use the exit value of the business to repay the loan. Is that correct?
Yeah. What can happen at the sale of a practice, if it's a limited company share sale, it's possible that it kind of all just gets wrapped up at that point in time. So that sounds a bit like I'm kind of being a bit mysterious about the whole thing, which I'm not trying to be, but I'm just trying not to kind of go too jargony. But it becomes part of the value of the company you're selling. You effectively get paid for it and you pay your loan back.
Yeah.
And that triggers the tax refund. And
if someone's interested in any of the things we've spoken about, what's the kind of best first port of call?
First thing I would say is get in touch. Book some time with me. Happy to chat these things through with anybody. Again, these things sound like broad, sweeping kind of solutions. They're all going to be unique to people's circumstances. So I would say we absolutely need to speak. I need to understand your situations, your goals and objectives, what your plans might be, so that we can recommend whether this is or isn't the right course of action for you, and what the tax savings might be. At
the very least, it's a case of if that's not an option, like we mentioned with the grandparents, then at least you've spoken about that.
Yeah.
Because I imagine if a tax advisor comes to you and says, you can do something and save a lot of tax, like a lot of these old accountants were with that grandparent scheme, it's quite an attractive thing to buy into because, you've taken the advice and it sounds good.
Yeah.
But it's just making sure you speak to a specialist and it's done properly.
Yeah, absolutely.
Yeah.
Conversation is definitely the way to go.